The U.S. government shutdown has thrown the brakes on the flow of federal economic data at a moment of uncertainty. But if history is any guide, the shutdown itself is unlikely to have a lasting impact on the U.S. economy. Part of the reason is the previous 20 shutdowns have been short, lasting about a week or less. They are a headache for the Federal Reserve, especially now as policymakers seek clarity on the employment picture and inflation. Those policymakers won't get the monthly jobs report and other data until the government reopens. They will have to rely on private surveys. Sometimes those are viewed as a poor proxy for the government data. The Fed cut interest rates last month for the first time since December on growing concern about the job market. Financial markets see a near certainty of another rate cut at the central bank's next meeting this month. Though Bonrion Capital Management founder and CEO Shana Orzik-Sizzle says the shutdown could impact this.
I do think the lack of economic data of some of the larger economic data points that the Fed pays attention to could delay the Fed from cutting further.
Meanwhile, even though hundreds of thousands of federal workers are on furlough and a range of important government services are suspended, shutdowns themselves don't typically move the needle for the economy. It depends on what's happening around the shutdown. Stocks took a hit during the last shutdown in 2018, but rebounded quickly, according to Robert Conzo, CEO and Managing Director of the Wealth Alliance.
Last one was during the Trump era, was 35 days from December of 18 to January of 19. The market dropped, and it started a week before the actual shutdown, so there was a lot of anticipation. Dropped around 15%, then quickly came back and rose past that. Typically, there's headline risk, markets drop, but then they typically come back.